Hey everyone, and welcome to today's Explainer. As an investment analyst, I love digging into companies that seem, well, kind of boring on the surface, but actually have a massive hidden upside. Today, we're looking at TC Energy. You probably think you have this traditional legacy utility stock completely figured out, right? But as we unpack their latest financial reports and 2026 forecasts, we're going to uncover this totally surprising, high-tech twist that is completely redefining their growth trajectory.
So here is the big question we need to answer today. Can an old-school pipeline stock actually thrive in the modern AI era? I mean, usually when we think about artificial intelligence, we picture Silicon Valley, software, chips, right? We definitely don't think of massive steel pipes in the ground. But as the data shows us, the bridge between legacy energy infrastructure and skyrocketing tech demand is actually way shorter and, frankly, a lot more lucrative than you'd expect.
Let's run through our roadmap for this explainer. 1. The TC Energy Snapshot. 2. Breaking flow records. 3. AI and LNG catalysts. 4. Dividends and debt discipline. 5. Wall Street's verdict. And finally, 6. The final takeaway. Let's just jump right in.
Section 1. The TC Energy Snapshot, a continental giant.
So TC Energy, trading under the ticker TRP in both Toronto and New York, is currently hovering right around that 97 to 98 Canadian dollar mark. And if you're an income-focused investor, Calkin Research points out they're offering a forward yield right near 4%. They are, without a doubt, a top-tier North American energy infrastructure leader, managing this absolute beast of a network across Canada, the US, and Mexico.
And when we say leader, we are talking about incredible scale here. According to their own reports, TC Energy's network moves over 30% of all the cleaner-burning natural gas used across the entire North American continent. Just let that sink in for a second. Nearly a third of the gas powering homes, heavy industry, and, as we'll see shortly, data centers across the continent flows directly through their pipes.
Moving on to Section 2, Breaking Flow Records, the engine.
Looking under the hood, the company's CEO recently highlighted that their intense safety-first culture has driven some seriously exceptional operational performance. Actually, their system reliability was so strong that it drove an astounding 15 distinct flow records in 2025. We're talking all-time delivery records across multiple systems, including NGTL, Columbia Gulf, and their U.S. natural gas pipelines network, which hit a staggering daily average flow of 29.6 billion cubic feet per day late in the year.
And here's where it gets really fun for us analysts, because this perfectly illustrates their financial engine. All those physical flow records, they directly translated into cold, hard cash. For the full year of 2025, they cranked out a massive $11 billion in comparable EBITDA. In just the fourth quarter, they hit $3 billion and followed that right up in Q1 2026 with another $3.1 billion. So the infrastructure isn't just working, it is highly, highly profitable.
Next up, Section 3, AI and LNG catalysts, the fuel. So what's actually driving all this growth? The research points to three massive secular catalysts pushing natural gas consumption higher. First, you've got the ongoing coal-to-gas transition across the power grid. Second, rising LNG, or liquefied natural gas, exports. In fact, TC Energy saw their deliveries to LNG facilities jump 21% year over year in their latest Q4 report. But the third one, and arguably the most fascinating, is the absolute explosion in electricity demand from AI data centers.
If you want real-world proof of this AI demand pulling on legacy infrastructure, just look at their recent non-binding open season for a Columbia Gas transmission expansion. They were looking to add just 500 million cubic feet per day of capacity specifically to serve data centers around Columbus, Ohio. The result? They received 1.5 billion cubic feet per day in bids. I mean, the market interest literally tripled the capacity they were offering. That is the AI boom in action, folks.
All right, Section 4, Dividends and Debt Discipline. Capital allocation.
For you income investors out there, this is probably the stat you care about most. Early in 2026, the board approved a 3.2% dividend hike, bringing the annualized rate to $3.51 a share. But here is the kicker. As the sources emphasize, this marks 26 consecutive years of dividend growth. 26 years. That is a massive testament to the super stable, highly contracted nature of their asset base.
But look, they aren't just handing out cash blindly. Management is running a really tight ship. Step 1 was streamlining things via the South Bow spinoff to focus strictly on gas and power. Step 2, they are hyper-committed to deleveraging the balance sheet, aiming for a 4.75 times debt to EBI to target. And Step 3, they're steering clear of those massive, risky new greenfield projects. Instead, they're plowing about $6 billion a year through 2030 directly into low-risk expansions right inside their existing footprint.
Section 5. Wall Street's Verdict. Bull versus Bear.
Polling from MarketBeat data covering 15 Wall Street equities research analysts, the consensus is remarkably steady. We're looking at 9 holds, 6 buys, and absolutely 0 sells. The average 12-month price target sits at $90.79 Canadian, so it's a very neutral to positive vibe. Analysts clearly like the underlying business, but they seem to think the stock is fairly valued right now, basically advising folks to hold on and enjoy that steady income.
As analysts, we always have to weigh both sides of the trade. The bull case loves that sustained natural gas demand from tech and LNG, the super predictable cash flows, and a really impressive net margin of 21.8%, which just screams operational efficiency. On the flip side, the bear case points straight at the macro environment. High interest rates making debt expensive, plus the inevitable execution and regulatory risks you face whenever you build multi-billion-dollar infrastructure.
Finally, Section 6. The final takeaway. Calkine's industry report sums this up perfectly, stating, TC Energy appears well-positioned to deliver steady total returns, suitable for conservative investors. Look, this is not some explosive tech startup flyer. It's a highly dependable infrastructure play with a very balanced risk-reward profile. They've restructured successfully, they are smashing flow records, and honestly, they're perfectly positioned geographically to capture this huge wave of tech-driven power demand.
Which brings us to our final question. When you look at this infrastructure giant, one that's bumped its dividend for 26 straight years and has data centers fighting over 3 times the pipeline capacity it can currently offer, you really have to ask yourself, at a roughly 4% yield, does TC Energy's rock-solid operational stability and AI upside outweigh the broader economic risks? It is a genuinely fascinating question for today's energy market. Thanks so much for joining me on this explainer, and keep questioning the data.